Welcome to Fasken's 16th Annual Global Mining Group Seminar Series. My name is Virginia Schweitzer, and I'm part of the Fasken Global Mining Group. I'm also the co-managing partner of Fasken's Ottawa office. Today's webinar, Opportunities for Indigenous Ownership, Investment and Participation in Major Projects, is the 8th of our series of 12 seminars this year. For those watching online, there is a link to our seminar series beside the video window. And for those in the room, we have information at our registration desk. As you view the info slide on the screen, I'd like to provide a land acknowledgement. At Fasken, we have embarked on a journey of reconciliation, guided by our Reconciliation Action Plan. As part of this journey, we believe it is important to acknowledge the land and the people who have called this land home since time immemorial. Today in Toronto, we are gathered on the territory that has been the home of many nations, including the Wendat, the Anishinaabe Nation, the Haudenosaunee Confederacy, the Chippewa, and the Mississauga of the Credit First Nations. Toronto is also covered by Treaty 13, signed with the Mississaugas of the Credit and the Chippewa. We appreciate living and working here and recognize the importance of working to advance reconciliation between Indigenous and non-Indigenous people here and across Canada. Now I will turn it over to my colleague, Kevin O'Callaghan, to introduce today's speakers.
Hello, everyone. Thank you so much for joining us. Today we have a panel on Indigenous equity, and joined with me is Zach Romano, who has significant expertise in negotiating Indigenous equity. And we have Ian Palm, who is co-head of our Energy and Climate Group, as well as being a member of our Indigenous Legal Matters Practice Group. And I'm the head of that group. And our group has been involved in these issues from the very beginning, from Delgamuuk to HIDA consultation and the development of that, through implementing some of the first IBAs in Canada, and now at the forefront of trying to find creative ways of integrating Indigenous equity into mining projects. So I'm going to start us off. And just for those online, if you do have any questions, there is, I'm not exactly sure how or where, but somewhere on your screen is the ability to hit something, and those questions pop up on a little screen in front of me for the end. So please do that. But we'll hold for questions at the end. And so for those in the audience as well, there'll be a microphone that goes around if you have any questions. So I'm going to start us off talking about the drivers behind this push towards Indigenous equity. Zach's going to talk about some of the structures and practical means and ways of implementing that. And Ian's going to talk about some of the financial drivers behind that. So starting us off, why is this important? So there's a bunch of different drivers here, and one driver you'll all be very familiar with is the global demand driver with respect to Canada's critical minerals, not just an economic asset, but also critical for Canada's independence, developing our supply chain, and moving a bunch of kind of nationally important initiatives forward, as well as supplying the world. And there's an acknowledgement that this needs to be done, and needs to be done relatively quickly. And how do we get this done quickly? And everyone recognizes that the only way to actually deliver on anything in any kind of speed is to align those projects with the Indigenous rights holders who are the hosts of those projects. And if you don't do that, then the opposite happens. You get delay, cost escalation, and potential for failure. So then the question becomes, how do you align? And part of the context of that is, what are you trying to align? And what are the rights on one side of the equation? And many of you will know some of this, but I'll go over it relatively quickly. But Aboriginal rights or Indigenous rights in Canada were recognized and affirmed in our Constitution in 1982. But there's a misconception there. Those 1982 didn't create rights. It recognized pre-existing rights, rights that had existed from the very beginning. And that's critical to understand kind of the nature of those rights and how they are felt when they are held. And that's not just Aboriginal rights and Aboriginal title, but it's also treaty rights. All of those are protected constitutionally in Canada. So they gain a significant importance in the decision-making process. And then the case law, as I was describing, the Haida case, mid-2000s, said, look, you can't ignore the existence of these rights and the potential for these rights, even if they're not proven yet. There are duties to consult, duties to take into account those potential rights, even when they're not proven. And so that's why you hear a lot about consultation and the duty to consult. And then lately, you've been hearing a lot about the UN Declaration on the Rights of Indigenous People and its interplay with the rights in Canada. And that interplay has yet to be really figured out in any kind of real way, in any kind of practical way. And so what that does is create a lot of uncertainty. There are cases here in Ontario, in British Columbia, that are pushing their way towards the Supreme Court of Canada that'll give us a little more certainty on this. But you've acceptance by the Government of Canada that they will implement the UN Declaration in Canada. You have acceptance by British Columbia, Northwest Territories, the same. And within the UN Declaration, the Rights of Indigenous People, is this concept that you will have heard of, FPIC, Free, Prior, Informed Consent. So that is embedded within UNDRIP that has been adopted by Canada, but it has yet been determined whether consent in that context is a requirement or is simply to be the aspirational goal of the consultation that we've already talked about. So all of these issues create uncertainty that needs to be dealt with in that context. In addition, there are ESG standards related to the Equator Principles on borrowing money and the UNGPs, which are the guiding principles, all of which create a push towards recognition of Indigenous rights and having some way of dealing with those. So one might ask themselves also, like, where in Canada do you really have to deal with this? And I had a bunch of different maps and we were going back and forth on this, but I thought this was a good one. This is a map of all of the agreements just to do with mineral exploration or development between companies and First Nations all across Canada. So what you can see by this is that this issue needs to be dealt with basically wherever you are in Canada. There are dots in every single province and every single territory except for PEI. I'm sure it's going to come sometime soon when they find something there. Potatoes. Other than potatoes. Something you dig up other than potatoes. That's what the joke should have been. But you can see it's everywhere across Canada. You'd be hard pressed to find like a square meter of Canada that doesn't have some claim of Aboriginal rights, Aboriginal title, or treaty rights that might be exercised over that area. And so that's the issue. Now we need to reconcile those two and find ways of integrating those projects with the Indigenous hosts, and in such a way that people look at a project as our project. Everyone looks at a project as our project, and you can move things forward. And that's about economic reconciliation. That's about general nation building from a Canadian perspective, but also nation building from the First Nations perspective, building their capacity and knowledge and understanding of the area. And it's trying to find those opportunities for alignment of interest. Now, traditionally, the way that we've done that, the de-risking I talk about on this slide, is through impact and benefit agreements. So that's at the beginning, they started with kind of just general consultation agreements, moved towards impact and benefit agreements, which provide benefits in recognition of impact in return for certainty. That certainty usually comes in the form of either support or consent. And so that was the model for a long period of time, but there was a push both from First Nations and, frankly, from government, thinking that a better way to align interests is to have equity in the projects, is to literally become a partner in the project itself. But that is not a simple thing. There have been some drivers towards it. There's a lot of government money now available to guarantee loans, and we're going to find out more of that from Ian. There's the Building Canada Act out there, Major Projects Office pushing things forward to streamline approvals and financing, and there's a lot of talk about Indigenous equity being a part of that. And there have been some examples. I mean, I've talked with others here in the room about examples. Here are a few. But what you'll notice going through this slide is, well, the first two have to do with gravel and sand, which is a little bit different in terms of the outward financial modeling of it. But 10, 12%, 10%. The Williams Lake example here is an example that we've seen a number of different times across, where it's a much smaller percent and it's the transfer of shares, sometimes in the project itself, sometimes in the parent company developing the project. SK Creek, there is a percentage there, 1.8. The TTN example at the bottom is a future ability to gain up to 7.9%. Selkirk recently bought a mining operation, the Minto mine in the Yukon, but it was out of receivership. And so the exact organization of that in terms of their holding is yet to be entirely revealed. But what you can see by this is it's a few, very few, and only a few First Nations, and mostly taking a smaller percentage. There's a few examples out there of First Nations being the developer themselves, but they're relatively rare, especially on massive projects. It's much smaller. And there's a reason behind that. And it comes from a number of different directions. But at its core, it comes from the fact that if you are a First Nation, you've got 5,000 members, your budget is not huge, your bank account is not large, and you're approached by a company who says, look, we've got a $6 billion project. We're willing that you come in for up to $3 billion. And you go to the government and they say, well, we'll backstop you for $1.5 million of that. And you go to $1.5 billion of that, and you go somewhere else and they'll backstop you for the rest. And you went to a financial advisor and said, should we put what is essentially 1,000 times our GDP in one project and load it all up there? That financial advisor should be fired if they said yes. Like that's a very bad idea from a kind of, if you apply the general principles. And that is a significant problem because, as we know, mining is not without risk. You can have the best geological drilling program, but you can get underground and find out everything's falling down on you, or there's way more water coming in, or there's a dozen things that can go wrong with projects. And that's why the return needs to be so high on some of these. But it's very different from even a gravel mine, or even more importantly, pipelines that have long-term contracts, energy infrastructure that have long-term contracts and long-term guaranteed returns, where the risk profile is much less. And so we're going to hear a lot about examples of major projects that involve equity, but you'll see that they more often tend towards that direction. And so there's this tension between wanting First Nations to be involved, but that the risk profile of mining is difficult to manage. And And that creates a quandary. And we're trying to figure out ways out of this quandary right now and trying to find creative ways of figuring out ways out of this quandary. And Zach's going to provide all the solutions. Go ahead, Zach.
Thanks, Kevin. Excuse me. So thanks for the setup. I don't have all the solutions, but I can talk about some of the ways this plays out on the ground. And we have the good setup for why this is becoming relevant, but helpful to think through and talk about what we're seeing. And to start out, just wanted to set the stage with some considerations that would be helpful to keep in mind as you think about this issue going forward. First off, this is a situation where it's not your typical M&A deal. You've got a party, and maybe more than one party, as an owner, as a mining company opposite you, who is a government. They have obligations to territory, the obligations to future generations, rights within the territory. That inevitably changes the complexity and strategy you need to implement for your negotiations. There's no one-size-fits-all approach, and really, it's kind of trite, but it's true, and that's a function again of the complexity and the distinctiveness of the nations that you're going to encounter. At the same time, strategy, I think, is perhaps, I said it's as important as structure, but in many ways, it's potentially more important, particularly when dealing with opportunities for multiple nations to come into a project. The way you engage at the outset and being deliberate about how you're approaching those nations and thinking through what your structure needs to look like at the end is inevitably, how you get to close. And if you can't get that right from the outset, it doesn't matter if you have the best legal structure, if you can't build the collective and get everyone aligned. So when we think of entity, there's really 4 on the menu to be thinking about: it's corporation, partnership, contractual joint ventures, and trusts. Often, partnerships are for many projects where Indigenous equity has been contemplated, and particularly in other sectors where Indigenous equity has actually been implemented as part of a co-ownership arrangement. Partnerships, limited partnerships, are attractive because of the flow-through nature of them. The income and losses are calculated at the partnership level, but taxed in the hands of the partners. And for First Nations, that's important because they can earn a pre-tax return, and depending on their structuring, could be exempt. At the same time, with industry, early losses on a project, you can claim that against other sources of your income, which can be extremely helpful from your going forward costs. Now, in terms of the rub points, we have kind of recurring issues that come up on these transactions that we wanted to walk you through. And there's a number of these to talk about, but to set out a few of the relevant considerations that would be helpful to think about. We thought about thinking about equity, as Kevin set up, as part of the benefit mix when you're thinking through an IBA. The allocation question: who gets what and how much? It's a really important question to be thinking about. Governance, additional capital contributions, and exit rights, all important issues to be thinking about. You're not getting out that easy though, Kevin. So first off, equity. When we think about impact benefit agreements, there's about 57 different ways you can label these agreements, but at their core, they're essentially this. There's a commitment from the company about benefits and commitments in respect of a project in exchange for a nation or a number of nations providing consent, support, and legal certainty for a project. Now, how do you get that consent and support and legal certainty? Often that's done with a benefit mix that may include equity. And what we're seeing more and more is nations expect it to be part of the discussion. It's one of the benefits. There might be an NSR, there might be milestone payments, there will be milestone payments, but equity is increasingly talked about and expected. In some cases, and there have been projects where there is no IBA, it's just an ownership deal. But there's potentially considerable risks with that approach, depending on your context. And it's kind of simple. As you talk about equity, you think about aligning interests over the long-term life of a project. If an Indigenous co-owner sells their interests later on, what cover do you have for the impacts of the project on rights and title later? If you don't have an IBA, you don't. So you need to think through carefully whether or not you're going to proceed without a consent agreement and instead pursue just equity. Often, and I think typically, we're seeing that equity really isn't a substitute for a benefit agreement. It's one of the elements of the benefit mix in the deal. So allocation logic, it's really important to get this right, and it's hard. As the map Kevin showed us demonstrates, most projects, when you think about who's involved, which nations have a potential claim, may have interest in respect of your project, it's very rare that you have one nation potentially affected. More often, you have multiple nations who may be affected, and you may have multiple opportunities then to bring in Indigenous co-owners into your project. If you have multiple Indigenous co-owners, that becomes really difficult to think through in terms of what to offer and what proportion of the equity available to Indigenous nations will be available to each potential co-owner. There's various ways to get through this, to think through, well, is it, infrastructure and territory? Are we counting population? But in situations where you have multiple groups, it's really tough to tell one group they're essentially worth less than another. You have to be very careful at how you talk about that and implement it as part of your strategy. Governance is key. It's a key negotiation point. And what is material to think about here really is the types of rights nations will get as part of and negotiate for as part of these ownership structures may not reflect what you're used to seeing with respect to other types of commercial parties who have a minority interest in a project. It's kind of table stakes. If you're going to have an Indigenous co-ownership arrangement, the nation's going to have the right to appoint directors or officers to the corporate boards. At the same time, they're going to have opportunities to appoint representatives to managing and operating committees. But they're also going to have veto rights in respect of key issues and matters that could arise that will look like rights to make decisions about the timing, frequency of distributions. If that changes, you might be in a world where that's going to be subject to an Indigenous consent right. At the same time, material contracts that may have to be entered into in respect of a project, there may be, again, a consent right that you need to think through. It's just a couple. So you need to be very careful at how you negotiate and structure and think about those rights. At the same time, with some nations, they've had experience with an ownership position in a major project before. Other nations may not have. Where a nation doesn't have a history of owning an interest in a project, there is opportunities for industry partners to step in and actually facilitate capacity development. It sounds, it's not complicated. It's looking at ways to make sure directors on boards have the training they need to be in that role and understand the division between their authority and their roles and obligations on a board versus being a leader in their community or an employee of their nation. At the same time, there's opportunities to build in culture into the way decisions are made, into the way process happens at a board level, but also in terms of things like dispute resolution. There may be ways to think about how you resolve conflict within your organization that can be informed by the Indigenous partners you have as owners. Now, when it comes to additional financial contributions, there's essentially three ways that we've seen this play out in other projects, but it's at first instance, the idea that when the partnership or the entity calls for capital, calls for shareholders or partners to put in their share, there may be a world where it's essentially a closed environment. There's no ACC, there's no capital contribution required from an Indigenous owner. And in that scenario, there'll be no worry of dilution. The other scenario that we'll see is sometimes the capital contributions will be deferred to some future point in time. Maybe after a few years when a nation's had the ability to build up some income from the project, at that point there'll be a repayment mechanism built in. And the third essentially setup we see is owners being expected to put in a pro rata share of capital contribution when it comes up. And in those scenarios, you're often then negotiating about anti-dilution protections, capital loan facilities, ways to make sure that a nation can maintain its equity interest in the event that capital is called and they have to pony up. So last but not least, exit rights. Really important to get this right from the outset because parties may not align on what they think long-term means. You want an owner, as a mining company, you want to have Indigenous parties involved in your project as long as possible. But as Kevin noted earlier, nations have aspirations that may be more aligned up with divesting their interests, selling it, and then being able to redeploy that capital for other community development opportunities. So in this scenario, what we often see is that, the first setup, most common, is that Indigenous owners will have the right to sell, but it'll have to be either to the other co-owners. And if there's multiple Indigenous nations, the other Indigenous nations often want the shot at acquiring that interest. Same time from there, it gets more complex. You'll start to see drag rights. You'll start to see ROFRs. You'll start to see different ways of layering onto the complexity of how exit rights can look. But you'll often also be negotiating about lockup periods. You'll want to try and keep the nations involved as long as you can. And at the same time, there may be regulatory or financing reasons why that's necessary. So with that, maybe I'll hand it to Ian to tell us about how easy money is to get.
Yeah. Hey, folks. So thanks for joining us today. It's great to see so many people, and thanks for your interest in this. Well, I'm kind of excited about this area because we've seen some, from my perspective, as a M&A and leader of our energy practice and financing person focused on financing both small and big projects, we're seeing some degree of momentum. I know that is challenging sometimes in the mining sector to sort of hear stories about projects that take a long time to develop. But I think in when we think about it from the perspective of major projects, as our federal government has distinguished that, we're talking about a range of things: the infrastructure, we're talking about energy, critical minerals, mining. It's across the spectrum, and I think in some areas, particularly in the energy sector, we are seeing some interesting developments. And so, what I'm going to try and provide you is some context as to what has changed over the last few years that is relevant for the financial community. I come from the perspective of, look, I've lived and worked on Bay Street for 30 years. And I've had the opportunity to travel all over Canada, and I've seen lots of parts of our country, but commercially, my perspective is working with people who are managing capital, people who are making investments, people who are making investment decisions, banks who are making decisions as to whether to invest money into transactions. So, where's our clicker there? Thank you. So with that context and with the, why should you be interested in this, and how might you, as a member of the mining community or the financial community, how might you play a role here? I want to give you some thoughts and ideas and leave you with some things to start looking up. So we're talking about financing some of these projects. So as Kevin outlined in detail, there are barriers to accessing capital for First Nations. So under the Indian Act, land and reserve assets that are on reserve cannot be pledged as security to a lender. So as a lender, as Kevin outlined in his initial kind of overview, it becomes challenging to for a community to say, we want to make this investment, but going to a bank, how are we going to get that money if we can't, pledge the assets that we do have, which may be modest in a particular situation. So the impact becomes communities often can only access small or what we describe as carried interest, equity interest. And you would have seen from that chart that Kevin outlined that in some of the early mining examples, that the equity interest that they have is pretty limited, and it's dependent to some degree on the mine being successful. And it also, of course, results in higher borrowing costs and limited access to long-term credit, and makes participation in energy and infrastructure projects difficult, especially if you're you're financing a big project. These are going to take decades to build or to operate, and so you want to make sure that the credit is strong. So that's the barrier. So how do you unlock meaningful Indigenous equity ownership? And I'm not telling you this is a silver bullet for all instances, but I think in some cases we're seeing government play a more active, creative role in coming up with potential solutions. So, governments now recognize, not all of them, but and some of them are more engaged than others, that access to affordable capital is a primary barrier to Indigenous equity participation. And so Zach's outlined in large measure some of the challenges in negotiating those structures and engaging with the people. If you're bringing the debt capital to the table, you need structures that the government is prepared to support. And so what we're going to take you through is some examples of loan guarantee programs and co-lending programs that our federal and certain provincial governments have put forward that help First Nations in accessing affordable financing to reduce the capital cost and thereby lowering the borrowing cost and enabling meaningful ownership in major resources and infrastructure projects. So, how do these work? Well, what effectively we're doing is we're replacing missing collateral with government guarantees, thereby reducing the risk to lenders. Okay, we are thereby reducing the interest rates and extending the repayment terms, allowing communities to finance larger equity stakes. So if it's less risky because government's playing a role in either being a co-lender or providing a guarantee, then it frees up some opportunities for greater participation for Indigenous groups. It also enables participation in long-term revenue-generating assets, as Kevin alluded to, pipelines, power plants, transmission lines, other clean energy projects. And there's some concrete examples that we'll take you through in a few minutes here. The other thing it does is it encourages partnerships between First Nations, governments, private sector, and institutional investors on equitable terms. So it basically opens up the opportunities for the conversations around some of the rights that Zach's described in the context of how the equity partnerships work. If there's less risk to the debt, then you can have more detailed conversations about the scope and nature of the rights in respect to the equity. So, what are some of the programs? This is hard to see on the screen unless you're looking very closely, but you'll get access to the slides after. These two slides are intended to give you a broad framework of some of the examples that are available. So there's a couple of federal ones, and then I'll take you through a few provincial ones. So the two most important federal ones, the top one is the Canada Indigenous Loan Guarantee Program. This has been established by a very new Crown Corporation. When it was announced, it was proposed to be $5 billion. The most recent budget has increased it to $10 billion. The guarantee amounts range from as low as $20 million, so meaningful amounts, but not huge, up to potentially $1 billion. And these, the eligible sectors, it's across the board, but basically it's major projects. So large scale or capital intensive initiatives, across a bunch of sectors. The only sectors that are expressly excluded are gaming or casinos. So you can imagine mining projects, infrastructure projects, anything, transmission lines, power plants, et cetera, are relevant. The second row there is a program established through the Canada Infrastructure Bank, and that is the Indigenous Equity Initiative. This is not a guarantee program; it's a loan program. So this is co-lending. Basically, what this provides is loans between $5 and $100 million per project, and it provides financing for up to 90% of the Indigenous equity investment. So Indigenous community who wants to make the investment, in Kevin's example, 5,000 people in a community, they want to make an investment into the project. assuming that the project then fits into what they're after, and they're supportive of the project, the Canada Infrastructure Bank, assuming it sort of fits into their criteria, they can provide up to 90% of the Indigenous, the capital required at the time the investment's made. It then becomes a loan, which they're going to repay over time. So they haven't associated all of their capital or a very significant part of their capital to just this one project. It can be spread over time. Now, the scope of this this opportunities for this co-lending project, it's limited to clean power, renewable energy, broadband, clean fuels, and transportation infrastructure. It doesn't expressly provide for natural resources development, but as everyone knows, putting a mine in a remote location in Canada is going to require a range of different things: infrastructure, roads, power, all those kinds of things. So it's not just a question of can we make this mine work? It's what other infrastructure needs to be developed around it. So we think this is an opportunity that's relevant to the mining community as well. And we'll take you through some examples. The next few, so Ontario, they recently renamed it, but it's now called the Indigenous Opportunities Financing Program. It's part of the Build Ontario Fund. It now has, as a result of the most recent announcements from the government, up to $3 billion in total capital available. This is a guarantee program, and they've issued a range of guarantees. I think it's up to a total of $850 million so far under many projects. It ranges for as small as 3.8 million right up to 255 million per project. So not insignificant. It's focused on resource development, energy, and critical minerals. So again, very relevant to the mining community. Alberta. Now, Alberta established the Alberta Indigenous Opportunities Corporation, and the new federal one is modeled based upon this Alberta structure. So Alberta, again, it's a guarantee program. It's got up to $3 billion available under Indigenous equity loan guarantees, and the investment values range from 20 million up to 250 million, and it's and the opportunities as far as scope are considered. We've got a range of different sectors, similar but different to other jurisdictions. Natural resources, agriculture, telecommunications, and healthcare, which it's a little more unique. The Saskatchewan is next on the list there, but Saskatchewan gets some credit here because they've been at this for longer than anybody else, and they've got a program of up to 300 million. The loan guarantees that they've issued to date have been between 5 and 75 million, and they are focused on natural resources development and value-added agriculture and associated infrastructure. Their program excludes mineral oil and gas exploration, but once established, then it is available. So if you've got a facility that's going to be operating, and you're structuring and financing that kind of then this program would be available. And then the last one, and I'll let my Vancouver colleagues talk about some of the substance here, but British Columbia has announced a loan guarantee program. It's not fully up and running as of yet, but the framework is in development, and we can talk about that. But they've made no bones about the fact that they intend to be an active player in this space. So that's kind of background for what's out there. And I should say, before we go into some examples, and I want to, I don't want to get too much detail, but this is just two examples of how governments are playing a role, both co-lending and guaranteeing certain projects. There are other programs that we're engaged with for other clients, and there's other initiatives that governments across the country are pursuing in supporting Indigenous equity. So these are, in the interest of time, we're just focusing on these two areas. So the first one on the screen here, this is the first transaction that the Canada Indigenous Loan Guarantee Program came out with. So the last year in July, Enbridge spun off its West Coast pipeline system throughout British Columbia and there's a little bit in Alberta into a separate limited partnership. So you would have seen Zach's diagram up earlier. So think about that. That partnership was that limited partnership as a result of the transaction now holds all of the pipeline assets within British Columbia that make up the West Coast Energy. It was spun out into a separate entity, and as part of that, 38 Indigenous communities in British Columbia acquired a 12.5% interest in that limited partnership through a $736 million transaction. And that transaction was structured using both a $400 million secured bond financing guaranteed by the Canada Indigenous Loan Guarantee Corporation, and as well, the remaining money was provided through an unguaranteed bond financing, and so I had the benefit together with a team of people to participate in that transaction. We acted for the bond placement agent on the bond financing, and if you're engaged in the financial community, you would be very familiar with how these things look. So it's a pretty common bond financing. I won't say it's plain vanilla, but it's pretty straightforward. And because you've got a guarantee from this Crown Corporation on part of it, it makes some of the challenges and some of the risks a little more easier to manage. And so we think this is a good example of how we might sort of see further transactions down the road. This is a bit unique. These are existing assets. These are assets that are operating and have a long financial record that you can point to. But there's some interesting components to it. Like there's 38 different First Nations communities in British Columbia are now part owners of this asset. And you can imagine some of the challenges that we're involved in managing all this. But it's kind of a unique transaction. So a couple others. So the co-loan program that the Canada Infrastructure Bank has established. There's some good examples of in Nova Scotia. There's an energy storage project that was announced in 2024 to be jointly owned by Nova Scotia Power and a limited partnership owned by 13 Mi'kmaq communities. There are, in the interest of time, we're not listing them all, but there's a few other in Nova Scotia in the energy sector where you've seen both First Nations participation together with private sector participants. In Alberta, here are a couple of example projects that have come through the Alberta Indigenous Opportunities Corporation. So there's the Athabasca trunk line, where we saw 23 First Nations and Métis communities acquiring an 11.5% interest in 7 Enbridge operated pipelines, and that involved a guarantee of $250 million. And then the Cascade Power Plant. So this is a power plant which is a bit different from some of the other projects that we've described. So 6 First Nations obtained an equity interest in a $1.5 billion 900 megawatt combined cycle gas turbine power plant, and that involved a loan guarantee of $93 million. So those are some examples in Alberta, and then Saskatchewan. The couple ones that are of note, and when you get a chance, you can go check out their website. There's a long list of examples, but there's the Seven Stars Wind project, and then the the solar projects as well involve smaller loan guarantees. But you get an example. You get some, and these are ones that are under development. I should be clear. These are ones that weren't currently operating. So that's kind of a range across the country. And just to sort of summarize here, so what this does, so in broad spectrum, what this does is hopefully create opportunities for participation by other financial players across Canada to participate in this. So it's, it creates opportunities for commercial banks who may provide senior debt financing. So the Enbridge example that we put up there before, 230 million of that 730 million transaction was not guaranteed by government debt. So, that was something that commercial banks got comfortable with. Syndicated project financing, that's a number of those projects that we described there were syndicated bond financings. And again, this provides opportunities for Indigenous entities to play a role. And then we're seeing more interest in institutional investors, pension funds, infrastructure funds, sustainable finance-focused groups. Kevin started off the conversation, and we touched a bit on some of the UN and the ESG initiatives. Some of these transactions where it doesn't involve it involves, certainly renewables and other kinds of assets that are particularly appealing. They have the kind of significant interest to certain other investors because they meet other criteria as well. So I'm going to pause here and I'm actually going to pass the baton back to Kevin on what's next.
All right. So what is next? What you can hear from the conversation is that the idea of equity has grown and has been well used in the energy space and is maturing in that space. But that the idea of equity and how it can work in the context of mines and the development of mines still has yet to really settle on a method. And it may be, to Zach's point, there is no one size fits all for mining projects. Mining projects come in a lot of different sizes with a lot of different potential impacts with a lot of different risk profiles. And it may be, and equally communities come in all different shapes and sizes. Some communities are very large, very sophisticated, have multiple investments in multiple different areas. Their risk profile is entirely different than a First Nation that basically has no other income source other than the federal government and is small and isolated. The risk profiles of those two communities are vastly different. And likely their capacity for understanding and being able to kind of figure out the wisdom of that kind of investment is also massively different. So, but we need to figure out ways and means of closing that gap and creating that integrated approach across projects and First Nations, because there's a tension and between like the finance side, the financing side of equity and the advice that I talked about that a good financial advisor would give a community. And one of the main purposes of equity, it's not the only purpose, but one of the main purposes of equity is to align those interests so that you can get from the planning of a project to the construction of a project in a reasonable period of time, or even better, in a fast period of time. And that's what everybody wants. That's what I talked about at the beginning. But if you're looking at advising a nation on when they should take that equity stake, in a mining project, a good advisor might say to a nation, look, you don't want the uncertainty of how much it's going to cost to construct a mine. Everybody in this room knows that the first number of how much it's going to cost to construct a mine is very rarely the last number on what it's going to cost to construct a mine. So, a good financial advisor would be saying, look, you don't want that uncertainty and the cash call that might come with it and the risk that, once you go underground, it fills with water and maybe they have to shut the whole thing down. Maybe the equity you want to take is later. Maybe you want to do something now that would allow you to take that later. But then how is that going to align the interests at the outset to get to the yes? And it's trying to deal with those tensions that we're going through that process right now within the industry. To that last point, so we got government, third party options for financing and cash becoming more available, and there's going to be more pressure within the industry to find solutions to access that capital. Because if you're sitting there with a project trying to find the money to build it, the idea that there's this pool of guaranteed financing that the government's going to guarantee in the terms of billions of dollars is, that's a big shiny object there, and you want to figure out how to get access to that. And so there's a huge amount of pressure from all sides in this area, and it's going to be really interesting to see how it develops over time. So, standard disclaimer. CBD credits for those involved. You don't want to look at that for too long. And then that opens us up now to questions. Anyone here? There's a hand up back over there, and then after that, a hand up over here.
Thank you very much for this presentation. Can you comment on all the different financing sources that are currently available? What's the uptake on that? Okay. I mean, 10 billion here, 3 billion here, a billion here. Hasn't been taken up? I'm just curious. Okay.
Yeah. Yeah, so I'll start off, but Kevin and Zach may have some additional comments. It's pretty significant, right? So there's a number of transactions we're engaged on right now that hopefully will become public in due course. But Ontario, for example, the Building Ontario Fund, they put out 850 million, in commitments to guarantees of their $3 billion program, and to date, the federal one has only announced the first transaction, but we're aware of other ones that are around. So, and Alberta's been at this for a while, and Saskatchewan's been at this for a while. There's 8, 10, 12 transactions. So, if you're engaged in the community, you're trying to get a sense of what these are about. At this stage, as a financing lawyer, we get some pretty good metrics as to what these things look like, and so you can connect those into other financing. So I'm confident. I think government's discovered that using the strength of their capital as to support some of these guarantees, support the programs through guarantees have been, it's opened a door to some opportunities that I think didn't anticipate before.
Yeah, the only thing I would add there are two things. One is there has been a lot of take up already. A bunch of the projects that are oncoming could take up a lot of the available space, because as big as $10 billion seems at the outset, you can chew that pretty fast if you're looking at a pipeline from Alberta to the coast, for instance. And it's those the other aspect of those is that you have multiple nations involved, and so that the appetite for risk then is spread over multiple nations. So if each one of those was willing to take the risk of 100 million, you get up to $1 billion pretty fast. So that begs the question: what happens when all these things are tapped out? Does that mean it just all stops, or does government then pony up the next 10 billion? We don't know the answer to that. So there's a lot of space left, but there's a lot of projects that would be happy to fill that space. There was a question over here, and then come back over here. And while you're wandering over there, there was a question online, and it is: what is the return on investment message that you can tell First Nations trying to utilize their land trust funds or other funds that they may have in a new mining investment? So what's I guess it's essentially asking, like, what's the pitch that a mining company could have in terms of that return on investment? I'll start us off. And it's the same pitch that you'd hear on the conference floor to start on that return on investment. But that, for sophisticated nations, once they get the right advice and understanding, the reason why the return on investment is relatively high compared to something like a pipeline is because there is risk involved in that. So it's difficult to find a process where you could de-risk any kind of significant equity take in a mining project. Any other add to that from you?
Yeah, I would just add that if you're looking at any cap table and or balance sheet of a transaction, if you've now got government with a loan guarantee as part of the capital that's available, then you frees up opportunities for First Nations to put some equity on the table, like the examples of the Canada Indigenous investment program that the Canada Infrastructure Bank's established. I mean, those are loans of up to 90% of the equity value of the transaction, and so instead of putting in $100 of the band's money at the upfront, they're now putting in $10. Now they've got a loan they've got to pay out over time, but if they're interested in the return on investment, they can make some bets that they couldn't make earlier, with the support of well thought out professionals who are within the Canada Infrastructure Bank, or in the cases of loan guarantees. I mean, remember, these are guarantees, right? They're not, the government's not putting money on the table. They're guaranteeing the investments from institutional investors that are putting money on the table. But again, if you're looking about return on investment, it makes more risky bets possible than before.
Just to quickly add, I might suggest as well, from putting yourself in a nation's shoes, important to emphasize the critical advisors they'll need to be able to understand the return on investment opportunity. And as a mining company or as an owner, important to think about how you can facilitate that. It's in your interest for the nation to have the right advisors. They don't need a rights and title lawyer. They need a financial advisor. They need a lawyer that's done an equity deal before, and the same applies to yourself.
Thank you. Thank you very much for this highly informative presentation. Reference was made early on to Section 35 of the Constitution Act and the Aboriginal rights guaranteed therein. Just as part of the overall legal landscape that applies to these situations and transactions, we've seen a number of provincial governments override certain charter rights in a variety of circumstances, and I'm just wondering if Section 35 rights are rights that can be overridden legislatively by provincial or federal governments, or is that not permissible under Canada's Constitution?
That's a very interesting conversation. So kind of to reframe that, like you often hear about governments like Alberta and Quebec using what's called a notwithstanding clause to get out of having their legislation have to follow the Charter of Rights. Section 35 is not in the Charter, so that notwithstanding clause protection does not apply. But when the courts are interpreting Section 35 rights, they do so in a manner that essentially puts a very similar ability on governments to what's called infringe the right. And they need to justify that infringement. And so they have the ability to justify that infringement. But in order to justify that infringement, they would need to show, and the test is long, but they would essentially need to show that they did all the consultation, they offered something that was reasonable in compensation, and that there was a necessary, absolutely necessary reason for that right to be infringed. No one's ever successfully justified an infringement. So no one really knows what it would take. And it's not like you can just write a piece of legislation saying, we're justifying our infringement of this. You got to go and probably end up in the Supreme Court of Canada and explain yourself. So it's not, I think sometimes governments look for a release valve for the pressure that's building up. And it's not going to be a release valve in that sense. Anything to add to that? And there was one more question over here, and then we'll head back over there.
Say you have a project where there is Indigenous equity that's funded with a loan that has a federal or provincial loan guarantee, how do the subrogation rights work in the event that the Indigenous equity investor group defaults on the loan and the guarantee is called, and then you have, do you end up with the government as being, the kind of replacement equity investor or what?
So, very good question. And we given the fact we only had roughly an hour, we didn't sort of delve into the terms of the actual financings. But to sort of summarize your question, there are at what point if it's a negotiation, right? And you expect the terms. There'll be certain step-in rights that the Crown Corporation would have in the case of the loan guarantee. If there's a default, there's opportunities for the First Nation groups that would be involved to put in more money to cure a default. There's default, cure programs, and relatively, so there's a range of those kind of terms that are built in there. We're more than happy to kind of get into more detail, but there wasn't enough time at this point in time. If you're interested in sort of like doing an initial dive, the Canada Infrastructure Bank has a pretty good summary structure on their website of some of those terms. But yeah, there's that, and we've kind of been delving into this in some detail. But it's not different than what you would expect in the commercial context of another similar guarantee program.
The only other piece is, just to add on that, is when you've got multiple nations as part of the ownership group, it just gets that much more complicated with respect to how those step-in rights work and which nations will be, at odds if there's a default of one but not of all. It becomes quite complicated.
That's a really good point. That's a really good point. I think in most of the examples we had on the screen, there were like 36 First Nations or 12 First Nations, or it's usually a group. And usually what happens is you've got multiple layers of governance structures, so that the financial institutions are dealing with one relatively concentrated group, but that group is usually has to get the consensus of the broader group. And those things take time, and well thought out structures in advance will facilitate a much more efficient overall transaction structure. So keep that in mind if you're thinking about these things.
Hey, so those programs you mentioned, they're all great, but they're loan guarantees. They involve lenders. Lenders love operating companies, and they will get involved in projects that are construction ready, but they will not lend to development projects. So the guarantees don't kick in until much later in the game. Have you dealt with any nations or communities that actually want to put some development capital at risk and where they could get access to that type of funding?
Yes, and it's still at a point where lenders are obviously reluctant in a early mine development phase to obviously lend capital. The risk is so high, and then the lending rates become increasingly high because of the fact that you don't have a loan guarantee.
The lenders that will do the loan guarantees, and they will not lend before NTP. So
exactly. We've seen examples in the exploration space, for example, in BC, which is kind of becoming more the norm, is, Thesis is an example where they essentially did a private placement and funded the Tall Tans equity acquisition in the company. That's becoming more the norm, basically equity. They're funding it themselves. Okay. As opposed to free equity, that was sort of the norm for years, or the carried interest.
Just like any other developer then. Just
exactly.
Hope you have a good story and get out there and shake the trees.
Yeah.
Okay.
And just the other maybe quick point to add is the nations that are typically right now positioned with capital in the bank, like you think of a Musqueam or nations out east that have sufficient capital to actually think about an investment like that. They're not necessarily looking at mining. They're looking at other types of investments where there's a regulated rate of return, for example. It's a different game.
So we've talked about the financial participation and trends in that. I'm wondering if you can comment on any trends you're seeing in other types of participation, sort of direct management of the projects or training the local communities, things like that.
Yeah, that's a great question. I think what's becoming the norm is you've got the consent-based agreements, like the IBAs or the benefit agreement, whatever you want to call it, that typically provide those governance rights that, frankly, outstrip and go far beyond what a shareholder would have in terms of information rights as a minority player. And so a lot of the agreements that exist, very detailed controls around cultural mitigations, around environmental participation, around operational decision making as it pertains to permitting, both in early stage, but also throughout the life of project. And if anything, I think what we're seeing is that the expectations around environmental monitoring and mitigation particularly are becoming more and more sophisticated and more, you could say, onerous on company, but also more involvement by the nations earlier than may have been the case years ago, where there was a deal, but then you've signed and done. It's not like that anymore. It's collaborative. It's intended to be nations at the front end with the proponent making decisions together, as opposed to the former.
Another question.
Just while we're going to the microphone there, like the other thing to add is, we've talked about equity here, but equity facilitates other things. And if you've got an equity interest in a transaction, you then have, many of the rights that Zach's described, to provide that there be, certain jobs within the community, certain skills development opportunities, and other infrastructure development. So, this discussion was not intended to be specific just to that. I think one leads to the other in many respects.
Hello, everyone. Sebastián Donoso from Chile. First of all, thank you very much for the presentation. Very interesting. In Chile, indigenous lands cannot be used as collateral, so same as here. And I don't see the government coming up with any guarantee or loan programs, at least in the next 4 years. And on the other hand, indigenous communities don't manage, big portfolios, economic portfolios. So you said at the end of the presentation that pressure is on mining companies to maybe to come up with some sort of some alternatives to close the gap. So can you expand a little bit on what alternatives are there for that purpose? Thank you.
So you're talking about closing the gap between what? There, I missed what we're closing the gap between.
In terms of access to capital, in the absence of government programs and capacity of the indigenous communities to raise capital.
Go ahead.
So we recognize that these programs are not intended, are intended, or the examples we've given you show either existing assets or energy-related assets or other infrastructure assets. And we don't have a lot of examples. We don't have examples of these loan programs or guarantee programs which are, for mining exploration. However, in any mining development or other project development, there's lots of infrastructure around and that become necessary. So the overall capital cost of the development of a mine, perhaps, and this would be specific to the actual project you're working on, some of this capital that governments put on the table can be utilized to support the infrastructure development around that facility, and then free up capital for exploration and development of the actual mine through other sources. That's one that I think that's real. That's possible now. I think, assuming these are successful and perceived as being successful and wins for government, then there's a political decision to be made as to whether or not these loan guarantee programs can be extended to other more risky opportunities. And I guess that it remains to be seen. Government has taken on some risky equity opportunities in other sectors, and so maybe this is something that's a possibility in the future.
There have been some innovative examples, and actually, if you bring the mic just over here, I think Doug might be able to describe one of those for us.
Hi, thanks, Kevin. I work for a mining company that is 100% owned by the Norway House Cree Nation in Manitoba. They picked up the property about a year and a half ago. Long story about how that occurred. We won't go into that today. But to go back a few questions, you've laid out very well the kinds of support, loan guarantees, and so on that are available to assist a project to actually be built. That works pretty well, and that's available to First Nations. What we're working through right now, and this is something I've been living in various ways for about the last 5 years on this project, is that financing all of the study work that's necessary to go into your final development plan and to support getting it into production. There are lots of mechanisms that are available to like junior miners who do it all the time. Essentially, they list publicly, and at that point, they've sold the company effectively. And it's very seldom the junior that winds up developing the project anyway. In this instance, the First Nation is interested in preserving their equity position as much as possible. They're not so naive as to think they're going to be a 100% owner going into production. But the other thing is, when you're selling equity during that planning and sort of pre-construction stage, those are very expensive dollars. And so what we're beginning to see is some better government support that's becoming available to look after those studies. There's one program coming along that is going to be announced tomorrow, I believe, or I've so been told anyway, that will contribute, for example, to those feasibility level engineering studies, detailed engineering, those kinds of things. And that's really the missing piece for First Nations to be able to preserve a reasonable equity position. Like, they are going to sell a chunk of equity to do a partnership with a partner that can assist them with development, that kind of thing. But they want to have enough equity in their pocket so that they're still in a position to really strongly influence how the project is developed and operated. And they'll have slightly different objectives as far as profitability and benefits. They're more interested in employment, long-term employment. They'll trade that for slightly lower profitability. As an example, the other advantage First Nations have is they've got way more access to training funding than a junior miner would, and they get it a lot earlier. So what we've been able to do is to begin training people so that theoretically anyway, we could have an entirely Indigenous operated mining fleet, as an example. So that in this case, it's a planned open pit mine, so that 4 or 5 years down the road, when that goes into production, it can all be Indigenous operated. There will be other parts of the operation that can have a very significant Indigenous position as well. But then there's a much longer term objective of getting people into the more advanced training programs, scientists, engineers, geologists, that kind of thing, so that at the end of a initial 10 or 12 year mining stint, there's the possibility of transitioning to more Indigenous management than would be the case today. You're going to have to bring in expats from other parts of the country who are experienced in mining and operating and those kinds of things. But right now we're just working to solve that, how to deal with the study phase. And there's room for significant government participation. Yesterday, Manitoba made an initial commitment of $2 million toward the project to look after some of that. And we're optimistic the feds will come along as well. And this is one of the priority critical minerals projects in the country. And they're beginning to step up and provide assistance rather than just having these cattle call kinds of funding calls.
So when you talk about that funding from Manitoba, is that a grant then, or are they looking to get return on that investment sometime later?
Well, they'll get return on that investment, but it doesn't have to be paid back. It's a grant. So they're looking at investing to get a return in other ways.
Taxes.
Well, taxes is one. Much more significant employment in sort of that central part of the province than would be possible otherwise. Now, this is a very forward-thinking First Nation, and they've been working toward addressing one of the other questions that came up as well, is how do you share benefits with the surrounding communities? Well, what they've been working on is something they call the Wichiwewen Trust. And it would be applicable to resource development projects in general. And it provides a formula for the sharing of resource revenue based on location of the project, proximity of the other First Nations, the size of the First Nations, all of the things that you were talking about. But with communities signing on to that, it provides a really welcome formula for companies coming in looking, well, how are we going to deal with this? We've pledged so much resource revenue sharing, for example, but how does it get split up? And companies are very often quite challenged in dealing with that, but having that formula in place really simplifies it.
Any other questions? Thank you very much, Doug. I really appreciate you adding to the conversation there. I have one more question here that's specific. Are anti-dilution rights typically part of the deals? And if so, is it financing constrained or free carried?
I think it's a good question. On the deals that we listed on that slide, and as you can see, there haven't been a lot of deals out there where anti-dilution has come up. It's typically dealt with through in one scenario we're familiar with. There's essentially a capital loan facility that helps the nation keep their interest where it would be, notwithstanding the capital call. But inevitably, it's going to be constrained by financing.
No other questions? Thank you all for joining us today. Please join me in thanking our panelists and all of you for the discussion.
Thank you.